Welcome, everyone. Today is the Learn and Grow Meetup session. I'm your host, Vinky Loomba, with our co-host, Ruben Greth. We are dedicated real estate investors. I'm a fund manager as well. And we are very excited to explore the world of real estate opportunities with you and for you. Today, we have a very special guest, Jose Ortiz. Jose is just not an ordinary CPA, trust me. He's a founder of Scale Collective, a premium tax planning firm dedicated to empowering real estate investors to optimize their financial strategies. With over a decade of experience as a certified public accountant and certified tax coach, Jose brings a wealth of knowledge and expertise to the table. And today's session will uncover 6 pillars of tax planning, strategic road mapping to income, expense shifting, leveraging loopholes, optimizing income character investments, and maximizing tax credits. We'll learn how to mastering these 6 pillars can revolutionize our tax approach, leading to a significant savings and a brighter financial future. With that being said, Jose, stage is all yours, and our topic for today is stop overpaying the IRS, master your records, and master your taxes. Jose, all yours.
Yes, how you doing? How you doing? Thank you so much, Vinky, for that great introduction. Hello, everybody. Again, my name is Jose Ortiz. And Vinky, really quick, if you can maybe allow me to share my screen. Oh, there you go. You just did that. Perfect. Let me just go ahead and share. And let me know if you guys can see what I'm presenting at the moment.
Yes, we can see it.
Wonderful. All right. So let me just go ahead and share that now. Can you still? Okay, beautiful. Let me just make sure. There we go. Can you guys see the screen now?
Yes.
Okay, and you guys can see me moving. Can you see it? Can you see the screen moving? Oh, okay. All right. Well, let me just go ahead and reshare. Just 1 second.
And can you also go full screen? Instead, you can go the slide. Yeah.
There you go.
Yeah, there you go. Wonderful. There you go, guys. Always a little bit of a trick to get that working. So anyway, my name is Jose Ortiz. I'm a CPA and a certified tax coach. I've been doing this for several years now. I've been a CPA since 2015. I love real estate. I invest myself. It's just something that, I believe kind of I was born for. Kind of with my family. My dad used to be, started off working for fix and flippers. My dad was a really great contractor. And so basically through that, I got the experience of real estate, got the taste of it, got the curiosity. And from there, I've just been, learning more and more about tax because to me, I see it as a game that's always changing, right? They're always moving the goalposts. And that's a challenge to me, and it's a challenge to you guys, and I understand it. So I get a lot of my joy in helping my clients learn the fundamentals and learn through kind of a different approach that I apply. And that's called the 6 pillars of tax strategy. I'm going to go ahead and I'm going to move forward on my slide a little bit here, just so I can share the screen. And here we have on the left side, and everybody can see that. Just go ahead and let us know in the comment box if you have one. So we have the 6 pillars of tax planning, all right? And basically, what are they? Income shifting, and I'll go into each of these independently soon. Then there's expense shifting, loopholes, income recharacterization, investments, and tax credits. So those are the 6 pillars. Anything that you guys could think of as far as a tax strategy will be included in one or possibly more of those pillars, right? So here's the thing. Everybody gets excited about this stuff, because it sounds sexy, like it's for us investors and so forth. It sounds promising. But the thing that I've noticed is when I started off doing this is that while everybody's drawn to that, they still are lacking some of the things, and a lot of us are just because of the way maybe we were educated or the environments that we grew up well, and we find that we're lacking some of the fundamentals when trying to understand this game. Remember, it's a game. There's rules, right? And it's like that's the best way I could think about it. There's rules and there's boundaries and all those kind of things, and there's penalties, as we know, and there's referees. So with that being said, we have to kind of understand that this is a learning process, right? And the way it is right now in this environment is that, the CPAs that are, not all of them, there's a lot of great ones, but the ones that are out there are not necessarily investing the time in basically helping their real estate investors grow and get this. This is a prerequisite, guys. I think, so learning taxes and learning, what's involved, particularly with real estate investment, those are the rules of the game. And once you learn that game, then you can learn how to keep score, right? And then you could obviously, with that comes the tax savings and so forth. So what as far as providing my clients with that foundation, I created foundations first. So basically what happens is we go through a process of discovery where basically we talk about, where you are, obviously, in your financial journey, I would say, the financial road. And we kind of determine, I'm sorry. Okay. We kind of determine where you are in the financial road, like I was saying, what your goals are, what your strategy, what's the vision? Do you obviously you maybe need help with creating a strategy, particularly as it applies to tax. So that's part of the reason that you're there. But kind of getting to know your risk tolerance, know where you want to invest, how you want to invest, what's your timeline, right? Because all of those things, while we all know it, I believe in our head, we don't necessarily know how to apply it, right? Or put it down on paper at the very least. And, those are things that obviously come with time and education and with guidance. So the second thing that I noticed as I was starting off with this journey is that people just lack the fundamental education about tax, and I can understand it. I wasn't obviously born knowing this stuff. It's something that I've dedicated a lot of time to. But with an investor, maybe a lot of you guys are W-2 still. Maybe you have multiple businesses. It's hard to dedicate all that time to trying to learn this stuff. So this is why I'd like to provide my clients with some fundamental education, particularly as it applies, right, to real estate, right? What are those things that I need to understand when I'm getting into these investments, when I'm getting into a syndication, when I'm getting into a long-term rental, when I'm getting into whatever it may be, oil and gas? What are those core things that I need to understand about tax? So then we have that. We have the discovery and the education. So if we put those two things together, guys, then we are now building what's called a strategy, right? So that's going to help us push that all the way to the end, to the finish line, when we create the strategic roadmap, right? So we start building the strategy together, but we notice that in order to implement the strategy, what do we need? Processes, right? From a financial perspective, how are we going to develop these processes? Because a lot of things, I'll tell you, I'll make this comment. A lot of the things that go down, like you guys don't notice, and we maybe miss out on tax deductions and so forth, is because there's a lack of processes, right? And the thing about these deductions, the mileage, the home office, all those kind of things, is that that's just the easy pickings, right? That's a low-hanging fruit. So you want to be able to make sure that you have processes that make sure that they're efficient and effective in capturing, those receipts, those contractor itemized invoices. Notice I said itemized, right? All of those kind of things we want to be able to capture, and we want to have documentation for. Because to me, documentation is the number one reason why we overpay in taxes, a lack of documentation, proper documentation. So the next thing, so after we get back through the processes and identify what those processes are going to be, is we ensure that there's proper systems. Now, some of my investors, they'll come in with, their software already, their QuickBooks, maybe, anything else that they're using. But we have to kind of align that. We have to make sure that, the books are in good order. And this tax season, the last couple of tax seasons, I've noticed, there's just been a very, I don't know what it is, there's a lack of proper, systems, whether they're doing things in Excel or they're managing in some other way. There's a lack of capturing the proper documentation. So I'm emphasizing that a lot now moving forward, because this has become, I think, a growing issue. Because that's really, like I said, the reason why we overpay a lot. So getting these systems in place, capturing your mileage, right? Your children work for you, having them on payroll, right? And make sure that we have the roles and responsibilities just like any other employee. All of those kind of things will help you make not only yourself bulletproof from the IRS perspective, but ensuring that you're carrying out your tax, what we call it, tax game in an efficient manner, right? So I mentioned it earlier, all of that leads up to a strategic roadmap. And like I said, guys, I think we all think about these things. It's just that we don't have it maybe written down or structured out this way. But this is stuff that I've kind of gone through and, dealing with different kind of clients, dealing with, kind of the way I maybe had to adjust the way I saw things and so forth. But this is what the model I believe in. And I think it's something that every investor should at least consider. Does anybody have questions at this point? I just want to stop and maybe talk a little bit about that if anybody wants to make a comment or ask a question.
I hope you're going to dig deep in all the 6 pillars, right?
Okay, so basically, let's talk a little bit about the 6 pillars. And pillar number 1 is income shifting. So I'll make this comment as well. A lot of people go online and a lot of CPAs, knowingly or unknowingly, don't realize that what they promote on the internet or on these social media sites, they're actually tax tactics, right? But really, in terms of strategy, there's really 6, right? And this I learned from my mentor, Dominique Molina, who's brilliant. I feel she's a brilliant person. But she basically mentored me into understanding how to see tax in this way, right? So I like to share that. So income shifting is implementing strategies, right, to shift income to lower tax brackets or to entities with lower tax rates. So what do we mean by that? Well, let's think about the common things that we would know about real estate investing, some of the strategies. Well, we know that we can hire kids, right? What does that do? It moves, right, your tax from one bracket to a lower or 0 bracket. Okay, so that's actually a model right there. Kind of going outside of the realm of real estate, S corporation, right? So basically, we convert to an S corporation. What are we doing? We're trying to reduce the self-employment tax, right? Because obviously we have a reasonable salary, compensation, and so forth. So that is another form of income shifting, right? Moving it between years, right? Entities and so forth, and people, years, entities, and people. Pillar number 2 is expense shifting, right? So legally, and I always say legally, we are moving expenses to business entities or within time in a manner that maximizes tax deductions. So what can we think about? We real estate investors, what do we know about expense shifting? What's the most common thing that we do? Cost segregation, right? You accelerate your depreciation, right? What are we doing? We're expense shifting, right? To take advantage of those expenses in earlier years. So that's one of the most common forms. Here also, we talk about business deductions, right? Net operating losses, and even obviously another topic in real estate, passive activity losses. So these passive activity losses are something that we're used to seeing as well, right? So a lot of us are not necessarily real estate professionals, or we don't necessarily have short-term rentals per se. So we have to deal with that passive activity loss, planning, where we want to deal with that and understand how to take advantage of those passive activity losses. Loopholes. I just mentioned one, the short-term rental loophole, right? That's probably the most famous one in real estate. Why? Because obviously, if you have a short-term rental, the IRS considers that if you rent it 7 days or less on average, then they consider that a business. It activates your income from passive to active income. So you get your cost segregation, your depreciation. You could possibly have a loss that offsets your active income. And then income recharacterization. This is basically trying to, again, real estate professional is a good example. What we're doing is we're saying, hey, I qualify, I work in this industry, I meet these requirements, and hence everything that I'm doing should be considered active, right? And that's what it does. So it recharacterizes it from passive to active income. And then pillar number 5 are investments. Well, what would we call an investment that would be tax advantaged? Well, we know a bunch of them, syndications, right? Let's say that. Oil and gas, probably one of the biggest ones there. This kind of alludes to the next pillar, but solar tax credits, right? That's an investment. I've done that this past year. I took some of my investors into those investments, and it was great. It was wonderful because it eliminated a lot of passive activity gains for some of my clients. And then tax credits is the 6th tax pillar. And I mentioned solar tax credits, but there's a bunch of different things, research and development. Employers obviously get tax credits, right, for providing healthcare and so forth. Yeah, that's pretty much it as far as the pillars go. So I'd like to hear from you guys as far as questions, kind of understanding this. No questions.
Is there any questions from the audience?
Yeah, I have one. Can you hear me?
Go ahead, Jeff. Yeah.
Yes, sir.
I was talking to somebody the other day concerning oil and gas. And we were trying to figure a way that from our fund, we could invest in oil and gas and still be able to pass down some of those benefits of investing directly in oil and gas. And we've gotten mixed reviews from different people. So what's your opinion on that?
You know, that's funny. You're the second person that has brought that to my attention. And I did reach out to somebody, but I'm going to have that discussion with them again because it was a little vague to me about, what they were trying to tell me. Because the whole concept of that, just for those who don't necessarily have the understanding, is that with oil and gas, you have something, when you're doing the drilling and all that kind of stuff, you have something called working interest, right? So if you think about it, when you have you have an investment like a fund, right? And you have LPs, limited partners, right? Then we're talking about, and you're doing working interest, which you don't have any limited liability on. How do we resolve that? And, I'm still looking for the answer with that too, because I have, like you said, I've had mixed reviews. So I'm going to definitely talk to somebody that's kind of in law about that, because I think it's twofold. The problems are maybe there's tax, right? How would that all work out? But then also from the legality standpoint, if we have limited partners, with unlimited liability, how would that work? It doesn't, you know what I'm saying? There's just something weird there. So I'm starting to get some questions on that. Jeff, I think your name is. I'm definitely going to be kind of researching that, and I'll be posting something, and I'll send it to Vinky so you can distribute to your group for sure.
Okay. Yeah, I know we can invest through our fund, but not sure if all the benefits are going to be able to pass down.
Yeah, but the thing to me is the other question that I have is always with the LP stuff. You're a limited partner, right? Limited in every way. So then when you're accepting 100% liability, who's accepting the liability? You know what I'm saying? So that's the thing. And then that's even before we get into taxes. So that's the questions that I have.
Okay, I'd be glad to hear it.
Yes, sir. Yeah.
Yeah, me too. I would love
Yeah.
to hear that too. And earlier you mentioned when you were talking about the income shifting, and you talk about something, income recharacterization, right? And then
Yep.
you said you can hire the kids, you can do S corps, and we hear the horror stories about the S corp too. So, what other ways you can tell us that people can take their active income, where they're paying tons of tax, and just turn into maybe capital gain? So they can use that, the losses to write off against their capital gain. What is the best way or strategy that people can use?
Well, in terms of moving income to a capital gain, let's think about what a capital gain would be. You'd have to be invested in
Some kind of
securities, right?
investment. Mhm.
Right, some kind of asset. So that's basically, it would be difficult to kind of say, okay, this income is not, whatever it is, active or passive. It's, portfolio type income. So that would be difficult, but more the income shifting that we kind of like have to familiarize ourselves with is how can we activate, for lack of better terms, our passive losses, right? What is the key to doing that? We have the whole real estate professional thing. And like I said, and then you have the short-term rentals, which kind of, those are like loopholes and different ways of doing that, but there's really no way to address that outside of literally moving, transitioning. And I think a lot of people come to this conclusion, a lot of investors, because I've started to. You have to kind of, luckily I work in this industry, but you have to kind of understand that in order to get to that point where your passive income is, literally fighting off your active income, would be to be more involved in real estate, through a real estate professional. So what happens is, I think a lot of people throughout their journey will say, okay, I'm gonna work my way out of this job, right? And that's through real estate investing. And then finally, once they're out of that, then they can qualify. It's obviously almost impossible to qualify for a real estate profession when you're working at a W-2, because it's not only the 750 hours, it's that you have to work more in real estate than in any other, area, I would say. So that's always a challenge. So that's why I think the natural progression with a lot of people are, hey, I'm going to work my way out of my W-2. Well, I might love what I do, but there's obviously more profit, and this is more of my kind of game where I can control my income. I can control I can dictate what, happens to me tax-wise, and I can build my wealth that way.
Interesting. So let me rephrase my question. So what if we are working with the doctors or dentists, very high paying jobs? These individuals, they're not going to leave their profession and become or a full-time real estate syndicator. They just wanted to stay
Right.
where they are because they might be making millions of dollars. Because I know I met this doctor is making 2 million plus, and he's asking me for all the strategies. I'm like, I'm not a CPA. So if you were in my place, what would you advise him? How to leverage maybe real estate, maybe oil and gas? What are the best strategies for this person to save some on the tax?
Yeah. See, oil and gas is a good one, because that one, obviously, when you have your full liability, you're going to be able to write some of those off as active income, right? Because you're exposed there in a certain way. So a lot of other things that people do will buy, with doctors and so forth, they might buy a building, right? From there, obviously they own that building, right? And then they can rent they can lease the space and so forth. But the thing about it is, what I think people need to kind of get their to wrap their arms around when we talk about all this stuff, is that even though you may have passive losses and so forth, remember what happens when you sell, or when you decide to just dispose of the property. You have obviously different strategies like 1031 exchange, where you don't have to do that. And then if you do have capital gains when you're selling, you could also basically just move into another property within that year, right? And then do a cost segregation. That'll help pay off or offset those capital gains to a certain degree, to all of it, if you get into a new property that year. So there's different things you can do, but what my whole point about that is that even if you're accumulating these passive losses, we have to kind of consider that either way, we are basically reducing our effective tax rate. So there's always going to be a tax benefit to real estate investing, right? We have things that help shield us from taxes. It's this huge tool called depreciation, right? And everybody gets to use it. So even considering that, you know, maybe like we're talking about doctors, lawyers, and, you know, airplane pilots and so forth, all those kind of industries where you have high earners, even if you can't really, and I tell this to a lot of my clients because it makes sense. Even if you can't necessarily take advantage of it today, where you're doing stockpiling and you're putting bullets in your holster, right? And effectively, you're literally lowering your effective income tax rate.
We're talking about the legal loopholes, and we'd love to hear more on those. You know, what are the legal loopholes that we can use in day-to-day?
Well, okay, so there's the ones that pertain to real estate. Obviously, we already know the short-term rentals. Now, what other people, well, a lot of people don't understand is that there's something called Section 199A. It's a qualified business income deduction. This came about with the Trump tax law. And what it is if you have a qualifying property, or a qualifying business, I should say, you can qualify for a 20% reduction of your income tax right off the top, right? But a lot of investors, particularly those who are starting off that don't necessarily have, you know, that kind of experience, they don't necessarily know that, and they don't know how to obviously take advantage of that, right? Because what happens is, even though you have that loophole, you know, once you get to a certain income level, 200,000, I believe it is for married, it starts phasing out, right? So then the game becomes, okay, what if we have companies, we have our properties and companies and so forth like that, you know, how can I manage, because there's two things that they look at. They look at your wages and they look at, you know, the income level. So how can I manage my wages so that I can qualify for the maximum deduction that I can take and still get at least some of that 20% or all of the 20%. So that one's an easy thing because obviously it's given to you, you know, so long as you're not one of the disqualifying businesses. Like I'm an accountant, I don't qualify. Doctors, specialists, things like that don't necessarily qualify. So, but real estate does, you know, so people are not aware of that. So they kind of need to talk to the CPAs about it and ask those probing questions and challenge them, you know, and see how they can help them to get that, because I think it's phasing out after 2025. So that's all we have after that, unless it gets renewed in Congress. So that's one of the ones that's good for real estate. Now, a huge one is something called 1202. And, you know, if we have business owners in the audience who have C Corps, basically what that says is, if I hold that property 5 years or longer, then I can qualify for I think it's up to 10 million or 12. I think it's 12 million exemption, right, of my capital gain from selling that business, right? That's humongous. So that's one of those ones that you want to ask your CPA about, you know, how can I qualify? If I'm a doctor, you know, can I move it into a C Corp? You know, just as part of my, you know, exit strategy, you know, so that when I sell and if I have a profitable practice, I can basically get all of that capital gain, possibly tax-free. So those are those things that you want to think about, because, you know, while I focus on real estate, the whole idea of me working with my clients is that I'm taking a holistic view at everything, right? So I have people who have C Corps who are real estate investors, right? So you want to kind of learn how to play all of these things together, because it's a game, like I said, and there's different chess pieces. So what you want to do is learn how to play them all together, right? Insurance, anything that's basically tax advantage, you want to kind of look in every corner to see how much you can maximize from. It's not only real estate.
That's good. So Cedric has a question. Go ahead, unmute yourself.
Yes, you were just talking about selling your business, whereby, you know, up to, I think you said $12 million, you may be able to.
Yeah, I think that's, yeah.
Yeah. So me as a multifamily investor, general partner, how would I be able to take full advantage of that? Would I have to sell, say, like my LLC in order to take advantage of it? Versus, you know, just selling the property itself.
Well, I mean, remember what we're talking about? We're talking about C corps, right? So
Oh,
you would
okay.
need to
Okay.
basically, yeah. So you would have to kind of look for a creative, but something that could be substantiated way, right? Of either establishing a C corp and then maybe having some, maybe being a limited partner with that C corp on some of these investments and stuff like that. But that would kind of get hairy. We'd have to, you know, every situation is unique, so we'd have to kind of look at all of those different factors and how can you do that? Like I said, but playing within the rules, right? And obviously having purpose for what's behind what you're doing.
All right. Thank you.
Yes, sir.
So since you're on the topic of the C Corp, Jose, can you shed some light on C Corp versus S Corp? Like, you know, from LP perspective, as well as for the general partners or the syndicator perspective, which is the best route, possible route for us to take?
For real estate investors, you're saying?
Mm-hmm.
Well, that all depends. I mean, so if we're talking about investing in properties, right? Well, that's obviously, you know, you can do the LLC. It doesn't make sense to do it in an S corp, right? Because there's different regulations and so forth that can expose you to actual tax to gains off of your property sales to the S corp. So you don't want to do anything like that. So you want to stay with what I call is like the swinging entity is the LLC, because the LLC is, as you know, it's limited liability, but also you have the capability of moving to C corp, S corp, and so forth, right? So just very, very flexible. Now, when we're talking about management companies and, you know, all those kind of things, then we're talking more, that's where you can kind of take advantage of other things, right? So you could have, you know, right now, let's just say C corps are 21% taxable rate. And a lot of the reason why people they kind of like get scared of the C corp is because there's this thing called double taxation that we're all taught of, and it's true. However, right, what if I have a C corp where I want to be able to have that C corp help me make my investments in my properties? Now, that's the other thing where people normally will tell me, well, how about that whole retained earnings thing with IRS, where they'll charge you a penalty, you know, for having a certain amount of retained earnings and just not using it. That is valid. But here's the thing, there's about 30 some odd reasons. And when IRS agents get their handbook, they get a handbook, they list out all the 31 reasons, or however they are, as to why having a higher retained earnings above, or retained earning account above the safe harbor that they have, which I believe is like 250 or something like that, is acceptable. And one of them is in lieu of not getting into debt. You know, not in those words, but that's a very valid point. Why would I want to get into debt, right, if I have retained earnings I can apply? So a lot of what people can do is basically have that C corp there, be in a limited partnership with that C corp, and make the investments that way. And that obviously gets them at 21%. They don't have to worry about paying at a higher tax rate. Plus, you get to essentially save money in there, and you get to use that retained earnings for a variety of reasons.
Thanks. Jeff?
Yeah, I have a question on this is on kids. I invested some money for my grandkids, and I did it with their social security numbers, and all the profits that they're making goes back into bank accounts that were open to their open for them. And then they've been issued K1s each year. My understanding was if they make under $1,200 a year, that they don't have to file taxes. Now, my daughter decided to turn in the K-1 for her son to her CPA, who filed it along with her taxes and is being hit with taxes at her rate.
Oh boy.
And I was upset with her for, why did she give it to her tax man when he didn't have to file taxes at all? What's your take on that?
No, that's correct. But it sounds like there was a few things that were incorrect. So the standard deduction basically is the point where up to where your child can get paid without being exposed to federal tax. And it all depends. And there's certain age ranges where you start having to pay certain things, like, FICA, there's a certain age range and all that. So you have to kind of be aware of those things. Now, what I think what happened in your case was, if they hired them and they were paying them a salary, right?
No, this wasn't a salary. This was just profit from investment.
Yeah, well, see, that's the thing. So at that point, he shouldn't have brought it because so long as you earn under the standard deduction, there should never have been a problem. They're an investor, however, obviously they're being invested in, but they're at an age where they're not exposed to real estate to tax at that point. So no, I agree with you.
So her CPA shouldn't have included that K-1 at all in those taxes.
No, because so long as they're under that range, right, then basically they don't have to pay tax. Now, you have to be mindful of the age range, like I said, because there's certain requirements, I believe, I can't remember off the top of my head. I think at 18, you're exposed to, having to pay Social Security and so forth. So you have to kind of be aware of those things. However, but that's for employment, not for necessarily investment. So I would go back to them and check to see, what can be done, or bring it to somebody else for a second opinion for sure.
Yeah, he's only 11, so.
Yeah, no, that's crazy. That's crazy.
Yeah, but she's mad at me because she's paying his taxes.
Yeah,
So.
but I have a follow-up question on that. Since it was not paid as for the work or anything, wouldn't it be categorized as a gift to your grandson? So if it's a gift, right, you can give somebody some money out of your capital gain. Was it gonna fall under any tax bracket at that point?
Well, now
the initial investment was a gift, but the interest comes out on a K-1, the profit.
Right. So what they're paying on is the interest.
But shouldn't that it's a gift, right? But still, there's a tax liability on the gift too. I mean, regardless. And then
remember, yeah, but still, let's think about what's happening. So basically, he got a gift. That was the actual money that was for the investment, right? And now he's earning this recurring interest, right, Jeff? And that is what's being exposed to the tax. So that's what he's saying. They don't earn up to a certain amount of money that they can earn up to a certain standard deduction. So our standard deduction. So why should he be submitting the K-1 to the CPA? Yeah. So it's not like, Jeff, I don't know. I mean, is he receiving a check, or I don't know, but even still, he's 11 years old, and he's I'm assuming under the deduction amount. So
they're making a couple. They're making a couple $100. It's not anything a big deal, but but she turned it in with her taxes.
Yeah, so we'd have to kind of look at other facts and circumstances, but from what you're telling me, it sounds like you might want to take a look at it. For what it's worth, it's a couple $100. Yeah.
All right, thank you.
Cedric,
Yes,
you're next.
Yes, quick question. I invested as an LP using my self-directed IRA, and of course, I still get a K-1. Now, do I need to report that K-1 every year for tax purposes?
Whose name is it in? The investment.
The investment is in my name.
Oh, okay, but so you did it for yourself directed?
The self-directed IRA is
Okay.
the custodian, so to speak.
Right. So remember what happens with that. It's that's going to get reported all within the self-directed IRA. Remember, because the investor is who? The self-directed IRA.
Yeah. All right. So I'm saying for tax purposes, I shouldn't be, because I haven't. And my
Right.
CPA was asking me for it. And I'm like, but
Yeah.
this is in a self-directed IRA and I'm not taking anything out of
Right.
it. Okay.
Right. Exactly. So that's what you need to tell them. Just give them, whatever statement you get at the end of the year, and that's about it.
Okay. Thanks.
Yes, sir.
I have a quick question, if you may.
Yes, sir.
Do you have an experience with the foreign investors? And how
Do
would that change the strategy?
For foreign investors?
Yes.
I don't do a lot of work with foreign investors per se. I've done some Canadian, people who are purchasing some property here, but that's the extent that I've done as far as foreign investors. Now, it depends on what's happening, and if they have a LLC here, all that kind of stuff. So I that's not necessarily my wheelhouse. So I could have done a few things. I don't know if you have a question, maybe I could try to answer, or I can actually find the answer for you.
So again, I'm a Canadian. Some of my investors are Canadians. LLC is not a good idea, by the way, for Canadians.
Yeah, right, exactly.
Because they will be paying double tax in Canada.
And that's because you guys don't regard it as a disregarded entity.
Exactly. So anything else but an LP is regarded as a corporation in Canada.
Yep.
And you cannot deduct, corporate tax from your personal tax. So that's why you cannot pay double tax. But there are also other different rules in terms of co-segregation and what you can or cannot depreciate. And you have to really be careful if you have Canadian investors, because they could get hurt heavily on the Canadian side if you accelerate the depreciation or mostly accelerate the depreciation on certain items on the American side. Right.
That's interesting. Yeah. That I've never heard of that. That's kind of like interesting to me. So basically, what don't they? Do you know where the changes are? Do you know what the differences are?
Again, in Canada, for the interest, it's a little bit different. So interest in the US, you have to divide by 27 and a half years, right? In Canada, you can actually elect how much you want to depreciate.
Interesting.
We normally advise all of our investors to have it the same as on the American side. But in Canada, there are no incentives for accelerated depreciation. So that's especially important for heavy value-added properties, when like for Americans, it's very beneficial to accelerate a lot, like as much as you can, right? You get those tax benefits, but it doesn't work well on the Canadian side.
Right. Yeah. So, like here, as you guys know, whether or not we want to, we have to depreciate, right? The question is, do we accelerate depreciation through segregations and so forth? But the thing is, that opens up us to, depreciation recapture, which is a tax, right? The tax on whatever has not gotten, let's just say, fully depreciated when you sell a place. Now, I don't know in Canada, do you guys have, because you're letting people choose how they want, to elect to be depreciated.
So
it's
only, so it's there is a recapture, but you have to, again, you can select, but it's only applicable for the property itself, not for the improvement.
Interesting. Wow. Okay.
That's
so there's really no incentive. Interesting. Thank you for that. That's awesome. I didn't know that.
Yeah, so if you have Canadian investors, you might want to talk to their accountant in Canada to see what, like, to make sure that you're aligned.
For sure,
And
for sure, for
otherwise,
sure. Yeah, because you know,
they could get hit hard on Canadian side.
yeah, yeah, because like when a lot of them come to us, they're coming to us here in America just for the setup of entities, really. But really, we don't, because we're not a Canadian accountant, we don't understand what happens after that. So
Exactly.
yeah, it's a great advice. Yeah.
Yeah,
For
I
anybody.
normally had, like, we're working with you know, accountants both in Canada and the US for many years, and they're in full sync and talk to each other
Yeah,
to make sure that everything is aligned.
that's a great niche.
So
That is a really
yeah,
great niche. Yeah, yeah. Thank you for that.
Yeah. Jeff, do you have another question? Your hand is still raised.
His hand's getting
No,
tired.
I just didn't put it down.
Okay, I
There
thought
you
you have
go.
another question. That's good. Is there any other questions before I ask my next question? There's multiple ways you can expense to reduce your taxable income. So if you can shed some light on that, because I know if you have a corp, you can just say if you're using your home, you can say, you know, you're renting portion of your house, and you can do all those nitty-gritty things to save some money. So if you can
Yeah.
tell us what we can do and what are the don'ts.
Yeah, well, I'll tell you the big do, which I'm gonna harp on it again because, like I said, I'm really kind of talking about this year. Is your documentation has to be on point, right? Because we have things that we're saying we're going to take deductions on that we didn't necessarily go through the process of documenting. And what happens is a lot of people come to me with an Excel sheet and nothing more, and they come to me with lack of invoices and all that. So the first, like I said, these are the low-hanging fruit, is to make sure your documentation is on point. Now, as far as different things, as far as different deductions that we have available to us, what we want to do as real estate investors is we always want to, and I'm going to talk a little bit about tangible personal property. What we want to do is make sure that we can qualify for as much repairs and maintenance as we can during the year, right? And we want to be conscious of the rules when it comes to repairs and maintenance versus, what is a capital expenditure, right? A capital improvement, because it makes a huge difference. Capital improvements, you're going to get what happens. You're going to get a deduction, a depreciation deduction every year, right? So that doesn't necessarily work from a tax standpoint, right? If you're trying to, like take advantage of all the deductions and expenses that you can in the year. So what you want to do is make sure that your documentation is like I said, on point, to make sure that you have documented and you're aware of what type of things qualify for repairs versus maintenance versus, say, capital expenditures. There's a thing about tangible personal property in 2014. This whole thing came out regarding the tax code, and it says basically, because a lot of people used to, you might have a fourplex, and you would change, the 1AC and all that stuff, and basically you could write that off. Now, basically, you got to be very, very careful, because what happens is when they're looking, what the IRS is looking for is they're saying, hey, all of these different things, right? They're in their own category. Right. So basically, if you're trying to just kind of like clump everything and try to just do like repairs and maintenance and say it was, I replaced one unit and it was replacing everything. They're basically, what they're saying is, no, if I have a fourplex and I replace one unit, really what the amount that I can take is 25%, right? Because it was one and it qualifies on its own. It does not, you can't clump it up with everything else in repairs and maintenance or anything like that. So that's one of the other things that you have to be careful of. Now, if you mentioned something about people who are renting rooms in their house, and I have a few of these. The one thing I will say is that takes a lot of careful documentation. You want to know the percentage of square footage of each of those rooms, right? So that we could take deductions from, the mortgage, from all these different things. that we're paying, right? Because obviously if we have, say 12% of my room or my home is being rented, I want to be able to take that deduction. But what happens is a lot of people are not aware of that. They don't necessarily pay attention to those things, and they miss out on those deductions. Also the days that are rented versus the days that are not, right? So we have personal use rules, which I don't know if you guys are familiar with that. 14 days you have that you can use in order to be obviously considered a active income. You just 14 days, or no income, I should say. Anything over 14 days, then they start considering it more of a business, right? So basically what happens there, you want to be able to make sure that you document all the days that are rented, are actually available for rent, right? So that you can basically make sure that you're maximizing, your active losses versus having now what would be passive losses here. You're not qualifying for the personal use exemption.
Great. So one last question. So if you can highlight some of the common mistakes that we make when we're doing our taxes, that we should use that towards our advantage.
Well, like I said, it's always the low-hanging fruit. So make sure your documentation is on point every day, all day. And there's so much technology out there now that it's easy to do. So that's what I would say for that. You want to be aware of everything that you can deduct for travel, because a lot of people don't necessarily pay attention to travel, right? So you want to make sure that you document all your travel you have. You said when we talk about receipts, and everybody's always worried about receipts. Look, to me, I tell my clients, take a picture of it, save it in your Google Drive. I mean, this is super easy to do nowadays, right? With technology, save it in your Google Drive or save it in your Dropbox, wherever it may be, and then you have those images there, right? That you could either have your bookkeeper upload to that, or you have them there as evidence. You remember, you're gonna have a bank statement, credit card statement. Nowadays, you have documentation for everything, right? So long as you have those images there, that substantiates it. You don't need to worry so much about that. It shouldn't become such a big ordeal. So those are like those low-hanging fruit, because this is where everything starts, right? Make sure you get your education. I can't really emphasize enough what happens when you're getting into a real estate investment world, and it's really, really important for you to be able to understand the game that you're playing in and how to keep score, right? How do you know how you're doing if you're not necessarily maybe spending the time with with your finances as much as you maybe should. Remember, the other thing too is you have help. There's people that you can hire. It's who, not how. For me, right? It's basically if I'm not an expert or something, or if I don't feel comfortable with something, then I'm not going to spend so much time. Remember, I have other things that I can do that are more appropriate for my skill set. So find the right person to work with. If you're working with a CPA that it's not necessarily open to kind of helping you understand more about real estate, or maybe they don't have that, maybe that's not their core, that's not their wheelhouse, then find somebody that does, because those things are investments. We're investors. The first thing we should know is how to differentiate an expense from an investment, and that's an investment if you find the right person, because they're going to pay you back and then some with what they can help save you.
Thank you so much. Any more questions for Jose? Thank you, Jose. It was very informative session. Can you quickly share with us how can people reach out to you?
Well, I will go ahead and share right now my QR code here. This is my long presentation, so I didn't want to give you guys that, but here's my QR code. So if you guys want to scan that from your phone right there, that'll take you to my business card. And from there, you can go ahead and book a session with me, a meet and greet session. Just sit down for over 15 minutes, get to know each other, and see how we can help you kind of build wealth and build your real estate portfolio. Yeah.
Thank you, Jose. Ruben, do you have something? And also you wanted to tell us about our upcoming big summit. If you want to share that with all of us, we'll love that.
strategiccapitalraise.com is the registration. We have 50 guest speakers that are all like top-notch syndicators and capital raisers in multiple asset classes. They're fund managers. It's going to be ridiculous. So it's going to be so much fun. It's going to be a fire event, advanced capital raising strategies, not the ABCs that you hear, everybody else talking about. But this is 4 years of capital raiser show stuff, and we intend to blow people's socks off with this one. So strategiccapitalraise.com, get your tickets now. That's all I got to say. Thank you so
Thank you
much,
so
Jose.
much.
You've been awesome, man. That was fantastic presentation. I really
My
appreciate you
pleasure.
coming on.
Thank you.
Yeah, thank you so much. I put the link in the chat. So Ruben, one more time, strategiccapitalraise.com.
Yeah, spelled out phonetically, just the way it sounds, strategiccapitalraise.com. We're expecting 1,000 registrants. We got Richard Wilson, Annie Dickerson, Jeff, who's in the house here. Jeff Greenberg is going to be speaking on the fund to fund panel. We also have a fund managers, I should say, fund to fund attorneys panel, a customizable funds panel. Gosh, we have so many different panels. We have a multiple asset class panel. We have a debt fund panel. We have an oil and gas panel. We have a psychology panel. I think we have a mindset panel. We have like so many panels. It's going to be absurd. So please join us.
Yeah, it's gonna be mind blowing. And don't forget, we have some freebies too. It's a free event.
Yeah.
Anybody and everybody can join. But beside that, I think we have a special gift. And Ruben, I'm gonna let you share that as well with our audience.
I think there are a couple of things that we're working on. One, for anybody that upgrades to VIP, they're going to get a chance to win a $3,500 ticket to one of 2 events, which is the Family Office Club Super Summit in New York and the Family Office Club Super Summit in Miami at the end of the year. We have free workshops that we're going to be giving away. So we're going to be doing a bunch of random drawings throughout. So, I don't know how many people are going to show up, but your chances are pretty good especially if you upgrade to get one of those $3,500 tickets. We'll come up with some other stuff too. So
Yeah, thank you so much.
yeah.
Yeah, it's gonna be on June 7th and 8th, Melissa. And then we'll have raffles throughout the day for the workshop as well as for the super summits. So we're gonna have a few raffles in 2 days. Both days we're gonna have the raffles for the VIP attendees. Just wanted to emphasize that. Thank you, Ruben. Anything else you like to add?
No.
Thanks. And Jose, anything else you like to share with us? Last minute.
Well,
Any golden nugget?
you guys know what my golden nugget. You guys know where to find me if you're looking for expertise, if you're looking for mentorship, and if you're looking for tax savings. Reach out to me.
Thanks,
Thank
Jose.
you, everyone. We really enjoyed today's session. We'll see you next time, same channel, same time. Have a good one. Bye.